Well, active investing as a whole is certain to lead to worse than average results. Because if you divide the universe of investors, make it very simple, and have half of them never make a change in their holdings. They own half of all America, and they just sit there forever. What's their result going to be? It's going to be average, right? It can't be anything else if they own half of everything. Now, if that half is average, you do nothing, and then you have another half that's very active, their gross results also have to be average, since the other half is average. And then what they get is way less because they pay these huge fees. So I had this bet, for example, against hedge funds. And part of the reason I'm winning it big is because a very significant part of the original capital that went to hedge funds ended up in the manager's pockets, even though they underperformed an index fund. And it's a very interesting thing. Investment managers as a group produce a negative result after fees compared to a passive thing. Now, an obstetrician does a better job of delivering my wife's baby than I can do. And a dentist job does a better job of taking out teeth. And the plumber does a better job with the toilet than I can do. In almost every field, the professional brings something to the party. The professionals as a group in investments bring a negative results to their clientele. And that's a very interesting phenomenon to live with. If you spend your life doing something where your expectancy is to hurt your customer, and yet that is the case for professional investors.
Is that just because there are so many bad people?
No, not least. Not in the least. Most of them rationalize it one way or another. And they say, well, these people would do even worse on their own. They would do even worse on their own if they did a lot of trading, but they don't need to do any trading. I've got a farm, and if somebody told me to buy and sell farms for the last 30 years and constantly turn them over, I'd have a way worse result than just sitting with the one farm I have. But you can say, if I'm going to trade farms every year, I'm better off having an advisor. But that is not my option. And anything that adds to costs without improving aggregate results means a worse result for the client. And it really is interesting to me that you have tens of thousands, hundreds of thousands of people in the business, and you have all kinds of media devoted to the subject, everything else. And net, they are addressing a group who in aggregate, because of the expenses involved in it, are going to do worse than if they bought the average and sat for the next 50 years.
Warren, a moment ago you mentioned that you still are recommending that people invest in an S&P 500 index fund. Let me ask this question that came in from Kevin. He says, the last few weeks we've been hearing from active money managers that the day of passive investing is over. The historical safety of investing in an index fund long-term is gone. Would you please provide your thoughts on this topic, particularly in regards to an investment time span of 10 years?
Well, I can tell you I haven't changed my will, and it directs that my widow would have 90% of the funds in index funds, and I think it's better advice than people are generally getting from people that are getting paid a lot to give other advice. You don't make a lot of money advising an S&P 500 index fund. I mean, and how you can say the day of index funds is over? I mean, if you say the day of investing in America is over, I would disagree quite violently. And then is there something special about index funds being a terrible way to invest? I just don't think it's very hard to have evidence of that. I mean, if the index funds reflect the market and one side has high fees that think they can pick out stocks and the other side has low fees, I know which side's going to win over time. And you have to recognize that it's in a great many people's interest to convince you that they can do something that they may well even believe they can. And a certain percentage of them will do it from luck, and a few people will do it from skill, and that's what makes it so enticing that you can find the Jim Simons or somebody that's going to produce extraordinary return. And Jim and his group have done it by brain power. But it's very unusual, and incidentally, they are going to charge you a lot of money, and they're going to actually maybe close up their fund if they do it, because they can't do it with really huge amounts of money compared to how the record's been established in the past. So just have to recognize you're dealing with an industry where it pays to be a great salesperson, and it pays even better if you're a great salesperson and you can actually produce something. But the money is in selling. There's a lot more money in selling than in managing, actually, if you look to the essence of investment management.